Alright folks, let's talk about debt. It's that thing that looms over us like a grumpy landlord, demanding rent when we'd rather be buying avocado toast. Debt can be a real drag. But fear not, there's a superhero in the world of finance, and its name is asset coverage ratio. But before we unleash the ACR, let's set the scene. Imagine a company, any company. They've got shiny things, assets, and pesky bills, liabilities. Now, wouldn't it be great if there was a way to see if those shiny things could cover the bills if things went south? Enter the ACR, here to save the day. So what exactly is this ACR sorcery? You might have heard the term thrown around in financial circles, but what does it really mean for you and your investments? In simple terms, the asset coverage ratio is like a financial stress test for companies. It's a way to measure how well a company can handle its debts using its assets. It tells you how well a company can cover its debts by selling off its assets if it suddenly became a corporate yard sale. Imagine a company having to liquidate everything to pay off what it owes. Think of it as a financial safety net, except instead of catching you when you fall, it's more like a bunch of valuable assets strategically placed to cushion your descent. It's a reassuring measure of financial health. A high ACR means the company is sitting pretty, like a dog with two tails, financially speaking. It indicates that the company has plenty of assets to cover its debts comfortably. Lots of valuable stuff to cover those pesky debts. It's like having a treasure chest ready to be used when needed. A low ACR? That's like trying to pay your rent with pocket lint, not ideal. It signals that the company might struggle to meet its financial obligations. Now for the mathy bit, but don't worry, we'll keep it painless. Think of it as a puzzle, where each piece fits perfectly to reveal the bigger picture. The ACR formula might look scarier than a clown at a birthday party, but it's actually quite straightforward. Once you get the hang of it, it's like riding a bike. ACR =, total assets, intangible assets, current liabilities plus short-term debt, total debt. It's a mouthful, but let's break it down step by step. Let's break it down like a bad relationship, piece by piece, until it all makes sense. Total assets. Everything the company owns, buildings, equipment, that lucky stapler that never jams. These are the tangible things you can see and touch. Intangible assets. Things you can't touch, like patents and goodwill. Important, but hard to sell quickly in a pinch. They add value, but aren't liquid. Current liabilities. Short-term debts the company needs to pay soon. Think of it like that friend who's always borrowing a 20 and promises to pay back next week. Short-term debt. A specific type of current liability that's due within a year. It's like a ticking clock, reminding you of the urgency. Total debt. All the money the company owes, short and long term. It's the sum of all financial obligations. So you subtract the intangibles and current liabilities, minus short-term debt, from total assets. This gives you a clearer picture of what's actually available. Then, you divide that number by the total debt. This final step helps you understand the company's leverage. Voila! You've got your ACR. It's not just a number, it's a snapshot of financial health. Section 4, ACR in action. Tales from the corporate jungle. Let's say you're eyeing a company, let's call it Acme Anvil Corporation. They claim to have a solid ACR of 2. That means for every dollar of debt, Acme has $2 of assets to back it up. Not bad. They could weather a financial storm or two. Now let's look at another company, Roadrunner Delivery Services. Their ACR is a measly 0.5. Uh-oh, that's like trying to outrun Wile E. Coyote with a flat tire. For every dollar of debt, they only have 50 cents of assets. Not exactly a recipe for financial security. Section 5, ACR's limits. Because even superheroes have weaknesses. Now before you go using ACR as your sole financial crystal ball, a word of caution. ACR isn't perfect. It has its own set of limitations that you need to be aware of. It's like that friend who gives great advice but occasionally shows up late wearing mismatched socks. Reliable, but not flawless. For starters, ACR is based on book values, which are historical costs recorded in the accounting books. These book values might not reflect what those assets are actually worth in the real world, especially in a fluctuating market. It's like finding out your vintage Beanie Baby collection isn't worth a fortune after all. The perceived value can be quite different from the actual market value. Plus, ACR doesn't take into account a company's profitability, which is a crucial aspect of financial health, or its ability to generate cash flow, which is essential for day-to-day operations and long-term sustainability. It's like judging a book by its cover. You might miss out on a great story if you don't look deeper. So, there you have it, the asset coverage ratio in all its glory. It's a handy tool for assessing financial stability. But remember, no single metric tells the whole story. Always do your research, look at multiple indicators, consult with a financial advisor if needed, to get a comprehensive understanding and maybe invest in a good helmet. Just in case those anvils start falling. Better safe than sorry.